Okay, so we are live. Hello everyone. For the occasion of IEEE Day, IEEE student branches of its Pilani, Goa, and Hyderabad are conducting a webinar series on the topics of science and technology. This is the second talk of the series. Today, we have with us Mr. Mohit Bhandari. Just to give a brief introduction, he's an alumnus of BITS Goa. He is the CEO and co-founder of Strategy, an investment consulting firm which guides people to direct their money to a profitable stock and is ranked fourth globally in an alpha generation competition. He has worked with US-based hedge funds like Drex Quant LLC and World Quant LLC. His first startup, AlgoCard, was incubated at IMA and reached the finals of one of the most prestigious startup accelerators called as Y Combinator. His current startup strategy has raised VC funding from top VCs in India and Singapore. Audience is requested to stay till the end of the webinar for a Q&A session to get their queries answered. We will note a Google form link in the chat box for the same. We are pleased to have you, sir. Over to you.
Hey, thank you so much, Shin, for the kind introduction. No need to call me sir. I'm just recently graduated, right? So I have a 2016 pass out from BITS Goa, and really interesting to come back again and talk about these things at our own college, BITS Pilani. So I have a small presentation for you guys, right? We can go through it. So the basic aim is to help you understand what stock investing is, what quantitative investing is, what quantitative algorithmic trading is, and give you a brief on how you can go about learning those things. I have a very brief presentation that we can go through, but I want to keep it conversational. So anytime you have any queries, please feel free to unmute yourself and ask anything. Yeah, can everyone see my screen?
Yes, sir, it's visible.
Yeah. So these are the aim of the talk, right? Make you understand what a quant does. We'll build a sample quant model too, and I'll help you understand, how you can get started with this. So the first thing is, just a bit about me. So I'm from BITS Goa. I graduated in, I was a dual degree student. I graduated in MSc Chemistry and Electronics ENI. And the question that I was facing was, which way to go. I was uncertain, do I want to do tech? Do I want to get into core or finance? So how did I land up into finance? Being an engineering student, I didn't had any degree, I didn't had any professional experience to start off with. Into finance, I never had a minor too in finance. All of the things that I learned was from my own. Now, why finance? So I strongly believe that you're the average of five people around you, and that is what forms your choices. That is what forms your direction that you want to move in. So I was a part of Wall Street Club at BITS Goa, which was a very very good thing for me because I started to explore finance, explore what are the various domains there, and I eventually went on to lead the club as vice president in my senior year. And through Wall Street, I got to know about quantitative trading, algorithmic trading. And I worked with a couple of hedge funds in US, TrexCon, WorldCon, but my primary work was to make quantitative trading strategies for the US European markets. And that is when we thought of this idea about making it accessible to every retail investors, and that is where our startup journey started. Now, coming to what is quantitative algorithmic trading, I have this. I'm not sure many of you must have seen this clip. It's from a very famous movie. It's called Big Short. I recommend for everyone to just go through it, even if you haven't seen that movie. But there's a short clip from that. It'll help you understand. It's a fun clip. Yeah.
That's my quant. Your what? My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face. That's pretty racist. Look at his eyes. I'll give you a hint. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math. Actually, my name's Jiang, and I do speak English. Jared likes to say I don't because he thinks it makes me seem more authentic. And I got second in that national math competition. So you're...
Yeah, so that's just a short, funny clip from this movie. But basically what it tells is, what quant is, you have to make mathematical models. And that's what he's asking, are you sure of the math? and he shows that Chinese guy, that he comes, he is a top genius in maths and all. But that is the basic hypothesis, that what we do in quantitative trading and investing is basically making mathematical models, right? Now, why are we making these mathematical models? So the idea there is to make mathematical models to pick out stocks, right? Now, why are we doing this? Essentially to make better returns, to generate better returns than, let's say, a benchmark, which is Nifty 50. So you want to generate more returns, and you make mathematical models. You find out how you can, beat the markets by creating certain portfolios which are giving consistent returns. So you make a mathematical model and you backtest it, and the idea is to generate maximum returns, right, while minimizing this risk. Now, why this is in demand, right? The obvious reason being that you can actually make lots of money through this, right? So basically, if you have a strategy, a quantitative algorithmic strategy which gives you good returns, you can invest your capital into it and generate more income out of it. So let's say I want to put in 1 lakh of my rupees, and I have a strategy which is giving me 50% returns in a year, right? So I can make 50,000 on top of 1 lakh, which is my initial capital, right? And that is why this is in demand, because not everyone can do that thing, right? But everyone wants to grow their money. So everyone wants to invest, everyone wants to grow grow their money, and that is why there are a lot of demand for people who can make these mathematical models, right? So you can see this is sample strategy. You can see that this is the return of the strategy. This is benchmark, which is Nifty 50, and you can see that we are consistently beating the benchmark, the Nifty 50, and that is the idea with these strategies, right? That you have to generate extra returns. Now, how can we make these mathematical models? What are these mathematical models based on? Right, it's basically based on any kind of data, right? So it can be price volume data. So what is price volume data? If you see the charts of these stock prices, right, there are prices, there are volumes, how much of that stock was bought. And there are fundamental data sets, right, like revenue, profits, how much revenue is that company making, how many profits are they making. Then there are fundamental ratios, how basically understanding how good a balance sheet of a company is, right? So that is also a data. Then there comes sentiment analysis, where you can scrape out data from Reddit, Twitter, and just try to understand what is the sentiment going on there. So this is very useful in crypto too. We are doing something there, but basically, you can even use such data. You can use the data of tweets that people do to analyze, how is the sentiment related to a stock, to make a strategy which will give you returns, right? So it's based on data. There are price, volume, fundamental, sentiment data. It can be something crazy like satellite imagery too. So there are hedge funds in US, and what they do is, they take out satellite imagery from satellites, and what the image that they take out is, let's say, the number of cars parked outside Walmart, right? So they basically see how many cars are parked outside Walmart. Then according to that car, the number of cars in that image is, they try to predict, what would be the revenues of those people. So they take timely, let's say they take every hour. Then they'll figure out कि एक दिन में how many cars were there outside the Walmart in their parking. Then they'll analyze, okay, how many people went in, and then accordingly they'll try to understand, are the revenues better or worse than previous quarter or something, right? So it's basically based on data. You can use any kind of data, price, volume, fundamental, sentiment analysis, something like satellite imagery too. You can even use rainfall data, right? So if you have a thesis on rainfall, you can use rainfall data to pick out stocks, right? So one such example would be when the rainfall is very high. What happens is, the crops grow good, and that is why there's a lots of demand for the tractors, the rural vehicles, right? Tractors and all of these other things, and that is when these stocks rise, right? So accordingly, you can even model these things. So that is the general essence of that you make models based on data which pick out stocks for you, and you also figure out when to enter, when to exit those stocks, making a good profit out of it. Now, let's try to build a model, right? So what is this ice cream out there, right? So I think everyone of us loves ice cream. We love to eat them during summers. Now the thing there, if you see an ice cream, is that the business is somewhat seasonal. So what I mean by that is, there are businesses which are seasonal in nature, right? So for example, let's say Vadela, which is an ice cream company, it sells more during summers, right? Now, when it sells more during summers, the revenue shoot up, and that's why the stock price rises, right? So they basically see more revenues, more profits coming in when there are summers, right? Because more and more people are eating ice creams. They're selling hell lot of ice cream out there. Every flavor is getting sold, and they're making a lot of money, right? Now, this is an insight. Let's try to build a mathematical model around it. Let's try to see if we can make something on this insight and create a quantitative or an algorithmic strategy out of it. Now, so this is basically the chart. So this is the stock price. The green line is the stock price of Vadilal. Right, the Vadilal is mentioned here. This is the number. So it went from 200 to 800, then dropped back. And the green dots are the sales, how many sales they made, and the red ones are profit. So there are revenue, then there are profits, right? So revenue or sales basically means how much of ice cream did they sold, right? But for every ice cream they sell, they have certain expenses, right? Warehousing costs, transportation cost, the cost of baking that ice cream, and all of those other costs, right? So when you cut down all those costs, the thing that you're left with is called profits, right? So if you can anyone see an interesting phenomena here? So if you see, after every three dots, there's a jump, there's a spike in sales, right? So 1, 2, 3, jump, 1, 2, 3, jump, 1, 2, 3, jump, right? 1, 2, 3, jump. Now, why is this happening? The same reason that we talked about, right? Everyone eats a lot of ice cream in summers. We might not realize it, but we eat much more ice cream in summers than winters. So that is the idea there, right? And you can see it in the data. The data is telling us that after every 3 quarters, there's a jump in sales and a subsequent jump in profits too, right? So 1, 2, 3, jump, 1, 2, 3. So let's say you start off here, they're negligible profits, even loss making, then loss. But when summer comes, they make a hell lot of profit, right? Now you can use this data to actually figure out stocks which can give you good returns, right? So we'll be using this data. If anyone has any question right now, let me know. But so we just took an insight about ice cream, and we're analyzing it on data and trying to make a strategy out of it. Now let's convert this insight into a model, right? So as I talked last time, right, that these are basically models which are based on data. So right now, the data that we are using is the stock price, the revenue, sales data, right, which is basically a fundamental data. And we have an insight which is about ice creams, and we'll try to convert this into a strategy, right? So let's say we build a model something like this, right? So the first step that we do is, we filter out stocks with seasonal revenues. Now, how do we find out these seasonality in revenues? So we'll see if the quarter one revenues are consistently more than quarter 2, 3, 4, which is the case in this one, right? So the revenue of this quarter is always higher than the other quarters of the year, right? So this would become true. Then we check for the consistency over the years, right? Is this happening every year, right? So we're talking about ice cream, but if we take the whole lot of universe of all the stocks, we'll find more seasonality in other stocks too. So for example, something like ACs and all sell more during summers, right? Something like coffee and tea sell a hell lot more than in winters, right? So demand for them rises in winters. Certainly, there are other seasonal businesses too. So, but this is the model that we are creating to generate returns from this insight. Then we will check the average returns in those quarters. So let's say Q1 average return, the stock is giving 10%, but for every other quarter, it's less than that. So this is a model which can tell you, how good is the seasonality in that stock, right? Now what we can do is we can rank the returns in that quarter minus returns in other quarter, right? So basically, let's say a stock rises 40% in a specific quarter, right? And the quarterly revenues for that quarter are higher than the other quarters. So basically, we can rank it according to this formula here, which is returns in that quarter minus returns in other quarters. So let's say there are 100 stocks that we have, a stock universe of 100 stocks. We rank them accordingly. We pick out the top 10 stocks, right? Pick out the top 10 stocks. Now we have a portfolio consisting of these top 10 stocks, which are seasonal in nature, and which give higher returns in a specific quarter, right? So that is basically seasonality. So what we essentially did was, we started with an insight. We checked out if the data supports that insight, and when the data supported it, we created a mathematical model, which is basically formulas and conditions to filter out certain stocks which fill that condition. So now we are now we are having a portfolio of 10 stocks. So what we do, right? So now we have a model. We started off with an insight. We had a model. We created a model, a mathematical model. Now we need to convert that model into a strategy, right? So what we do basically is we backtest it on historical data. So historical data is basically, I'll start from 2004 and I'll say, if I would have used this model to filter out stocks since 2004, how much returns would I have made, right? So let's say this is the returns and this is the benchmark. So benchmark is basically Nifty 50, and we can compare it with that, to analyze how good or bad is a strategy. So we basically backtest it on historical data. Then we analyze the metrics. How are the risk scores for that? How is the volatility looking? How are the sharp? How is the Kalmar ratio? All of these other metrics we track and analyze that we can improve on certain factors. So we can see the drawdown and all. Then once we have analyzed it, we again try to optimize the portfolio, right? So there are multiple ways to optimize it. Many people use ML in the optimization too. So this is basically a ML model. It's called HRP, hierarchical risk parity. And what it basically does is, if I have a portfolio, right, and I'm investing all of my money into a sector, let's say a banking sector or something like a textile sector. Now, what happens if the regulation comes in that textile exports would be taxed more? These kinds of regulations keep coming in as the government, RBI, and all of the trade association, they keep changing these regulations and all, which impact the businesses. Now, all of my money is put into these textile stocks and they got affected by a regulation, right? Which is basically higher taxes. So what will happen is my portfolio will tank, right? And because all of my money is exposed only to one sector, whole of my portfolio will go down, right? So that is why it's important to diversify your portfolio, and you can diversify your portfolio among various sectors. So let's say the green one is tech sector, this is something else. So basically hierarchical risk parity is used to diversify your portfolio, right? So out of those 10 stocks, we'll make sure that these 10 stocks, there are 5 different sectors, 2 stocks in every sector, right? So this will diversify our risk, which will eventually lead to better metrics, right? And a better backtest result. So that is the idea with it, that we start off with an insight, we create a mathematical model out of it, and then we backtest it and try to identify trends and all. Now, this was specifically on this data set, right? This insight was from this data set. Now I can work on various other data sets. I can work on sentiment analysis. I can work on something crazy like, I talked about rain data. I don't know how many of you are aware of blockchain, but for every transaction is out there in blockchain. So I can even analyze the blockchain data to figure out, which wallets are buying how much cryptos, and accordingly create a strategy out of it, right? So it can be anything. You can even make strategies on temperature. So basically insight, you take that data and you create a model out of it. This model was based on fundamental data and price volume data, both of them. You can even make models on combination of these data sets. So yeah, that is what we did. We created a model. Now, how do you start, right? So basically, all of these I am sure it might seem a bit, don't get overwhelmed by this, but it's very easy to start off. You just need to learn Python. So you can get started with learning a programming language. Python is the best out there right now for these kinds of things. Then you learn the basics of stock investing. I would recommend reading about Zerodha Varsity, the first 3 modules. You can read about them. There's a good course by DataCamp, Python for Data Finance. You can have a look at that, right? So basically, you need to understand how you can work with data sets, how you can work with financial data, and you need to learn about those things. And the best way to learn is actually by doing, right? So there are lots of GitHub projects out there, which like backtest certain trading strategy based on a technical indicator or something like that. I would say just straight out go to that GitHub project, download it, try to read the code, understand it, and use it in, let's say, another data set. If there's a project worked on US stocks, you understand it, take insights, and implement the same in the Indian stock market data, right? So that is how you can get started, and that would be the best way to learn about it. Then you can try to work at various funds, investment advisors, etc., and it'll give you a very good understanding of how the industry works, right? But before doing that, you need to prove that you can do such things, right? And how will you prove that? By doing these things, right? You'll have to learn about Python, stock investing. You should be very knowledgeable about these things. Plus you have to do certain projects which will help you, which will basically prove these funds and investment advisors that you are capable of doing something like this. Some good courses out there too. On Coursera, you can check out Algorithmic Trading by ASB, even Advanced Algorithmic Trading by ASB, and both of them are pretty easy, a very simple course, but it'll give you a brief understanding of how things work, right? So I'm basically, we're working in strategy, right? So what strategy does is we bring out these quantitative strategies to retail investors, right? So sophisticated investment products like hedge funds and all were only available to ultra HNI people with lots of money. We are trying to bring that to retail investor, normal people like you and me. And what you can do is you can invest in ideas, you can read bite-sized stock insights. So anyone who wants to learn more about quantitative trading, quantitative investing, I would say go out to strategy and check out all our strategies. Read their description, right? Their description given for all of those strategies, the monthly, weekly ones. So you can go and read out them, and then you'll get an understanding of what I'm saying. So the strategy that I mentioned, this one, it's called seasonal starts. It's one of our strategy, which is called seasonal starts, and it is based on the same phenomena. Like, so there are numerous other strategies that you can go and check them out, just learn more about them, and you can even research about them on net, and you'll find lots of data out there. You can even read about bite-sized stock insights. If you want to learn about any stock, I would say you can just check that out. It's quite informational, and if you do investing, then you can surely invest in these ideas and strategies, and meanwhile also learn how they are built. So that is the case. Our journey till now, we recently raised VC funding. We are a team of 10 plus people, 2000 plus users. It's going good right now. Just, we're scaling the team, scaling the product, and just product development and all of those things. But yeah, that was the idea there. Would love to, I've talked too much. I would love to take questions if anyone got anything out of that.
Okay, I will check the Google form.
Hello?
Hello, am I audible?
Yeah, Roshan. Audible.
Yeah, I will check the Google form
Sorry?
for the question. I will check the Google form
Okay.
for the questions, and I'll be back.
Okay. Hope this was helpful. Any feedback, anything anyone wants to discuss, please feel free to unmute yourself and we can have a discussion.
Personally, I'm very interested in this field, so like it was quite an insightful session, and like we also got to know how we can get started in this field, because like the field itself sounds like very tough or difficult to get into. So like, it was a very informative session.
Thank you, Roshan. Yeah, I hope it was. Great.
I'm
Hello,
currently new
Mohit.
to this field, but Janil, you want to ask something?
Yeah, you can go ahead. I can ask afterwards.
No, I was just asking that, like till now, the session has been really informative. Thank you for that. What kind of strategies do you have, at your website? Like you're saying, strategy had some kind of strategies that the people can go and look after for.
Yeah, so as I talked, right, there are numerous data sets that we can work on. So we have strategies based on fundamental data set, based on technical data set, right? And lots of other hypotheses. So one of them I showed about, right, seasonal stars. Certainly there are other phenomena which you can, even understand, but those are a bit more technical. But the idea there is that, let's say there's a strategy which is called ORDR. So what it does is there's a research paper based on it, and the idea there is that they capture a phenomena which is called overnight return daytime reversal. So what it means is, if I see every stock And if I see how much overnight return did it make, overnight return basically means the return that it make from the closing price of today till the opening price of tomorrow, right? So if I see that return, and if it's a positive overnight return, which is followed by a daytime reversal, which basically means the stock closed at 100 rupees today, right? It opened at 102 tomorrow morning, but after opening it falls down and closes below 102, let's say 101, right? So this is a phenomena which is called overnight return daytime reversal. Now they captured the frequency of this phenomena for every stock for the past 6 months, right? And we take an exponential mean, giving more weightage to the recent data, and we check out, we rank stocks according to this frequency of this phenomena happening in them, and then we basically filter out stocks, right? So the hypothesis of the paper is that the overnight returns are actually driven more by retail investors, right? And the daytime reversals, the daytime movements are driven by HFTs, by institutional investors and liquidity providers and all, right? So that's the basic idea of that strategy. There are a couple of more which you can understand. There is something called analyst expectations. So what happens is every analyst, they come up with expectation that this company will make, let's say the company makes 100 cr profit this quarter. So analysts come up with expectation that next quarter will make 120 cr. So what happens is, let's say the actual results come in and the actual results were much better than what analysts expected, right? So these analysts, these are like investment bankers, all of these working for big banks, big institutions, they publish reports and all. So let's say they expected 120 cr profit should come, but actually 150 cr profit comes out. So this is a overreaction. This is a unexpected move which the market was not expecting. So what happens is the price rises more, right? Because the actual results were much better. Similarly, if the actual results are much worse, the price can go down too. So these kinds of strategies, yeah.
Hello, Mohit.
Hey, Janil.
Yeah, so actually, I was asking a question which is not exactly related to algorithmic trading, but in general about stock markets in India. So, what do you think about like the saturation in stock market in India, like in Indian markets? Like, when will it be reached, or what the present scenario is according to you?
Okay. So for stock market, right? Talking about stock market, we should understand what stock market is. The stock market is actually a system, an engine, which is made to rise, right? So it'll keep rising. That's the thing.
Yeah.
There'll be certain. So there's a very strong data set, which if you see, it's very crazy. That if you see every 10 years, there comes a correction of 10-20%, right? Since
Mm-hmm.
inception for stock markets. But since inception, the stock markets have increased 29,000 fold, right?
Okay.
So eventually they are designed to go up. Certainly there are risks involved, right?
Yeah.
But what I think about stock market, especially in India, is that we are very nascent stage. So the retail participation right now is very low. In developed countries, it is more than 60-70%. In India, it's less than 5-7%. So lots of people will be investing in the future. The reason being that if you see the rural population, all of these other people who are not contributing to the economy right now, they will actually start earning. So the average income across towns, across villages will be increasing, and all of these people will also be investing. So the overall retail participation is going to increase. So lots of people will be coming into investing right now, and India is at a very nascent stage right now. We don't have hedge funds. We don't have, they are not developed as such. And there is one more other data point which you can see to just check, understand this better, that there are more VCs in India than hedge funds, right? Which
Yeah.
would not be the case for developed economies. Now, what's the reason for that? That these companies are being built at the initial stages, right? Startups are being built, so
Yeah.
VCs are putting money into that. But once these startups become bigger companies, they'll get listed on the stock markets, right? And that is when the stock market whole ecosystem will grow. So if you have seen recently, Zomato did an IPO. Many of these startups are doing an IPO. So it's a very great stage for Indian equity markets right now, and I think it's it's going to increase in the coming years. But when I say the coming year, it means like lots of like 10 years, 20 years will increase. Certainly, we'll see some corrections in between, right? But the markets are at a very good stage.
Oh, nice. Yeah. Uh, Also, I'm of an opinion that however, uh, however great we train the algorithmic models, there is some sort of like emotional attachment with the like sentimental investments that uh, like uh, like we personally do, right? So, how do you personally differ both, like differentiate between the both, like algorithmic trading and personal trading without using any such models?
Correct. So certainly the emotion part comes in, right? As humans, we have certain limitations, right? Now I
Yeah.
cannot, if I have a system, I cannot analyze it for thousands, 2,000 stocks, right? But a
Yeah.
computer then can do it, an algorithm can do it, right? A model can do it. So that is where our part becomes easier. That the system can do lots of work for us, which a human cannot do manually, right?
Hmm.
And that is where you find out more opportunities, right? Because now you can analyze tons of situations, tons of data sets, and tons of scenarios, so you can come up with something better, right? So that's the first edge that you get. You can actually analyze more and more data set. The other edge that you already talked about, the emotional thing, right? While you're doing quantitative investing or algorithmic trading and all, there are fixed systems for exiting, for entering, which will basically not be subjectable to your emotions, to your thinking and all. So that is one thing. Certainly you can do discretionary trading too, you can do discretionary investing too. That's a good idea. Like you can do that, but certainly having a mathematical quantitative backing actually makes your decision better too. So what we do for even our capital is that we have these strategies running right now. The strategies, they give us certain stocks. So let's say we get 20, 30 stocks, then we filter them out through qualitative analysis. We check them out, how is it going, how is it looking, have some discretionary part there too. But certainly the base should be a system which gives you an edge, right? Edge in the market to actually generate good returns over a long term.
Okay. Yeah. Makes sense. Cool, man. Oh,
Okay, yeah.
Okay, so there was one question in the form. Does the strategy fail when enough people start using it? That is, when the information is priced in. This is like a,
When more people start using it.
yeah, when enough people start using it, that
Mhm.
is the information is priced in.
Correct. Yeah. So there are two parts to this question. The first part is if more people put money, right? So every strategy, they have a capacity. So right. So let's say their strategy has 100 CR capacity, right? If more money comes into that strategy, what will happen is you'll incur slippages, you'll incur market impact costs, and the profitability will reduce, right? I'm not sure if you guys understand, but what I mean by market impact or slippages is that, let's say I have a 100 CR strategy which is buying 100 CR worth of stocks. Now uh, let's say there is enough liquidity in the market that I can actually take those orders, I can punch those orders and get my position at 100 CR. But let's say the amount doubles to 200 CR. Now what happens is when I go to market to buy 200 CR worth of stocks, the same stocks, the prices will rise because of my buying, right? That is called market impact. And certainly all of these strategies have a capacity, and if you invest more than that, the profitability reduces, right? So that is one thing. The other thing is the information disparity, which was the other part of the question, which basically says that, if my model is out there, right? If my model is out there, my exact model, and someone else is also running the same thing, then certainly the profits for me will reduce, right? uh, yeah, that is the case. So alpha does decay, right? Alpha in the market does decay, and that is why you have to constantly build, constantly fight for alpha. So even in our case, we are a MFT, right? A mid frequency firm. So we make bi-monthly, quarterly rebalancing strategies, monthly rebalancing strategies. For HFT, the alpha actually decays much faster, right? And they have to constantly, it's like a race that you have to run, right? So you have to be ahead of everyone else in the market. You have to keep iterating and keep making sure that your alpha doesn't decay, right? So certainly if more people get to know about that, they'll run the same strategy and the profitability reduces. In our case, the thing is we don't share the exact algorithm. So our thesis is that there are two things, right? The first thing is users should understand what they're investing into, and they should be able to basically trust it. Now, even if in the back end we have a complex quantitative model, which we have, right? But in the front end, it seems something easy which anyone can understand. So that's the idea with our strategies, right? So in the back end, there are complex models, but in the front end, we make it seem like a thesis, something which anyone can understand. So our model is not out there, right? So if our model is not out there, the information asymmetry doesn't come in scenario, because no one knows about our model except the team. But certainly the other thing, the capacity thing, every strategy has a capacity. When that breaches, then we have to stop that strategy. We have to put in our new ones. But the capacity are very high for our strategies, more than 100 CR for these investing strategies. So it will become a problem after 1 year or something. But yeah, great question. Yeah.
I guess the questions are over now. So thank you, Bhaiya, for this wonderful session. And I think the audience have got to have known some basic insights into this new field, into this new tech space.
Great,
So, and
great.
thank you for answering all the questions. Yeah.
Yeah, that was great. Thank you for having me. Hope you guys enjoyed it. And yeah, great
We
session.
definitely enjoyed it. Yeah.
Okay, great. And thank you so much, guys. If you have any questions or want to just interact, I'm there on Twitter and LinkedIn. You can just ping me there. But yeah, thank you so much, guys. Yeah. Okay. Shall all right, then I'll drop off. Thank you, Roshan. Thank you, IEEE team. Okay.